Hey guys, welcome to the video. Today it is one thing I wish I knew when I started investing, and that's how to choose stocks to invest in. All right, let's get into the first slide. First slide is step one. So to do that, you want to make a list of products or services that you and people you know use and love, and really important, those products should be significantly better than the competition. So once you make a list of things that you use and love, like you find a list of companies, you want to make sure that this company is actually public, so it has shares to purchase. So, for example, public companies such as Chipotle, that would have shares to purchase, but a private company such as In-N-Out, that would not have shares to purchase. So, for example, a public company, you would just Google company name and then the ticker symbol. So, for example, Chipotle ticker. So let me show you that really quick. If you Google Chipotle ticker, you will see the chart. And here, that's the ticker symbol CMG. So that's how you know if it's a public company or not. And then, if you cannot find it, it might be a, uh, a future IPO. It might be a private company right now, and then they're going to go public, meaning they're going to have shares available in the future. So an example would be Thrive Market. So if you do an example of a Thrive Market ticker and you don't see the chart, another thing you can Google here is Thrive Market, the company name, a public company? And here you see Thrive Market is considering an initial public offering. So that means that right now, Thrive Market is not a public company, but they could be a public company in the future. So right now you can't buy shares of them, but maybe in the future you could. And then next, private example would be In-N-Out ticker. If you Google In-N-Out ticker, you don't find anything. And then after that, you can do like, is In-N-Out a public company? So just Google that. After that, you'll see In-N-Out has no plans to pursue franchises or a public offering. That means that right now it's unlikely that In-N-Out will have shares to purchase in the future. So unfortunately, even though you may like In-N-Out, you cannot invest in them right now. Maybe later on when they do if they do decide to do an IPO, but like for now, no plans about that. And then next, you want to check to see if it has a parent company. So In-N-Out, I already know that has no parent company, but for example, something like Riot Games, you Google Riot Games ticker. So first you see no stock for that, and then after that you can Google Riot Games parent company, and then you'll see, oh, Riot Games parent organization, Tencent. So you Google Tencent. We did Riot Games parent company. Now we do Tencent. Tencent ticker. So we found Tencent, next Tencent ticker, and we have the chart for Tencent. The ticker for Tencent is TCEHY. So if you want to invest in Riot Games, the best way to do it is by investing in Tencent. The only thing about investing in Tencent is that Tencent, they do own Riot Games, but it's not like they own only Riot Games. So by investing in Tencent, yes, you are getting a share of Tencent Games, but you are also purchasing a share in a bunch of other companies as well. So that's something that you would want to be aware of. So yeah. Anyway, that was step two. And then next, step three. Step three is to split your list into two, one for beating the market and one for not beating the market. And what do I mean by beating the market, not beating the market? So usually the market is the S&P 500. So what is the S&P 500? That is the 500 really large American companies such as Tesla, Apple, and Bank of America, and so on and so forth. And the S&P 500 shows the average stock price changes. So let me show a quick chart of that. S&P 500, there we go, .INX, that's the ticker for it in Google Finance. So right now the S&P 500 is at 4,536.19 points. And you can expand it a little bit to see it right there. That's S&P 500. And then if you're someone who wants average performance, people usually buy something that copies the S&P 500. For example, the Spider or the VU, and that does its best to mirror the changes in the S&P 500. So let me show you the Spider really quick. So this is the Spider, ticker symbol SPY. So the changes in the Spider, we can take a look at this compared to the S&P 500. It's going to be very similar to the S&P. So if we compare it, let's compare it to SPY. You'll see that it is very similar. Not 100% similar, but really similar. So here you can see that this number right here, S&P 500, here it's the Spider, is a little bit off. S&P 500 right now is at 38.82%, while the Spider is at 39.01%. So it doesn't copy it perfectly, but it copies it pretty close. So yeah, that's what people invest in. Usually the Spider or the VU. I think the VU has a slightly lower has slightly lower fees, so sometimes people go for that. But then the SPY has been around longer, so sometimes other people go for that. But yeah. Anyway, let's keep going. The goal is to do better than average. That's why we pick individual stocks. If you're picking individual stocks, but you can't get performance that's higher than the S&P 500, I mean, there's not really a point in my opinion, unless maybe you're doing maybe dividend investing, probably. Yeah, I don't know. I'm not too much of an expert on that, but yeah, I usually choose individual stocks to beat the market or beat the average. So you want to compare each company in your list to either the Spider, the VU, or the S&P 500 chart. So next I'll show you that in the 1, 2, 3, and 5-year charts, and you can find that on Barchart. Google Finance, you can do that in Google Finance, but Google Finance doesn't have the 1, 2, 3, and 5-year chart. Let me show you that really quick. So yeah, so if right now we're comparing two things, let's just change it really quick. Let's do like Adobe. Yeah, so right now Adobe, the comparison for Google Finance, it lets you do it for 5 years and also 1 year, but it does not let you do it for. Let me go back. For this, the 2-year or the 3-year. So for that, we're going to use Barchart. So let's go over there. Okay, so this is barchart.com. For this search bar right here, let's type in the Spider, so SPY. Click on that right there. Close the ad. And then click on Full Chart. Then click on this arrow right here. And then for me, I like to change the mode to dark mode. So just click that to change it to dark. And then after that, you want to change this to a line. So to change it to a line, click Settings. Then make sure you're at Symbol, Bar Type. Click here. Change this to Line Chart. And then Apply. So this shows us a line chart for the Spider for a 6-month period right here, 6 months, for the daily. So it shows the price changes every day. So we want to compare this to one of your stocks. So for me, I'll be doing Adobe. So let's compare it to Adobe. Click Compare right here. For symbol, type in the ticker, ADBE. And then after that, you want to uncheck this left mark. Make sure that's not checked. And then we want to change the color of the line. So since the Spider is blue, we'll make it a different color. Like, let's do gray. And then Apply. All right, now we have the price changes of Adobe and then the changes of the Spider. The only thing is, this shows the price change. We want the percentage change. So to change that, we go to Settings and then Scale. then scale values, percentage change, apply. There, now we have it all in percentage change. We want to take a look at the 1, 2, 3, 4, and 5 here. So you'll see that over here we only have the 1, 2, and 3 year. That's because we're on daily. We want to change this to weekly so that we get more options there. 1, 2, 3, 4, and 5. So here, 1 year, weekly 1 year. The blue line is the spider. The gray line is Adobe. And here you can see it's roughly the same percentage change. So it's about the same for the 1 year. If we change to 2 year, the Adobe stock is beating the S&P 500. It's at 131 and the spider is at 48. For the 3 year, still beating it. For the 4 year, still beating it. And for the 5 year, still beating it. So this is what you would want to do for each of your stocks in your list. You'd want to take a look at the 1 year to the 5 year chart and then see, is it beating it on average for each chart? Ideally, you want to have it beat every single chart. If it's kind of a mix, like it's beating it some years, but it's not beating it other years, then it's kind of like a judgment call. It's like, if I like to ask myself, if I buy this knowing that it only beat the market like maybe half the time, would I be able to sleep peacefully at night knowing what I knew right now? So yeah, there's no absolute 100% rule. It's all about what lets you sleep peacefully at night. So if, for example, you have a different stock, let's just say like I don't know, Google. And then just hypothetically, let's say Google is beating the market for the uh, 5 year chart, 4 year chart, 3 year chart. But for the 2 year chart and the 1 year chart, if it's losing to the S&P 500, it's like performing worse than average. Would you feel comfortable purchasing that, and would you be able to sleep peacefully at night knowing what you know then? So like for some people, they would be able to sleep peaceful at night, so they should buy it. But if you're someone who can't sleep peacefully at night knowing that, then do not buy it, because sleep at night and like your health, your mental health, that's the most important thing. So yeah, anyway, you'd want to do this for each of the companies. And if you want to change the company, just click compare. And then here you can just change Adobe to something else like Google, Goog. Okay, now we have Google. And you can also, to compare, you can compare multiple stocks if you want. You can do like Netflix, apply. So Netflix is going to be orange. See, now we have the spider, we have Netflix and Google. And then you can see the changes here in the upper, in this area right here. So the blue is the spider, the gray is Google, and the orange is Netflix. So yeah, that is bar chart. And then let's keep going with the presentation. Okay, so that was bar chart. Oh, I forgot to add the 4 year in there, so it should be 1, 2, 3, 4, and 5 year for bar chart. So yeah, as I said earlier, all years would be ideal, but if it's mixed, it's a judgment call. Just do what will allow you to sleep peacefully at night. So yeah, that's step 3. So now, after step 3, you should have a list of companies that are beating the market. So you want to have a list of 10 to 20 stocks that are currently outperforming the market. So outperforming the market as in for multiple years, for like ideally the 1 year, the 2 year, the 3 year, the 4 year, and the 5 year chart. But if it's for half, then it's a judgment call. So after that, if you're having trouble creating a list of 10 to 20 companies, then you can add in companies that you've heard of and think have great products compared to the competition. But those products, they don't have to be products that you yourself or your friends or your family have not personally used. So once you have that, you can do stuff like check places on YouTube or Amazon for product reviews. You want to do your best to find out what other people think of the product. So, for example, let's say let's say Tesla. Maybe you don't own a Tesla, you know nobody else who owns a Tesla, but maybe you're thinking of buying Tesla stock. You want to think, what would I look into if I wanted to buy Tesla's products, their cars? Well, you would want to find out if their cars are good or not. So you would want to find other people's reviews. So you can search YouTube for that, or maybe you can start asking some of your friends. Maybe you have a friend who owns a Tesla and you never knew it. So yeah, find out if other people think the product is good, and then if other people think the product is good, then it's something that you would consider adding into your list. So yeah, that's step 4. Next, step 5. After you have your list of 10 to 20 stocks, you can either watch the fractional shares follow along, uh, or actually 4. There should be or, not for. So watch the fractional shares follow along, or the whole shares follow along to see how to start buying your stocks. So you can find that on my YouTube channel. Just click on playlists right here. I have a playlist right here, this orange thing, that's for the fractional shares, and then this one right here, that is for the whole shares. So if you're in an account that lets you buy fractional shares, I would suggest doing that series because it's easier to dollar cost average your way into stocks with fractional shares as opposed to whole shares. But if you're in a position where you cannot buy fractional shares, then follow this one right here. Last but not least, step 6, which is a little bit more advanced and it's a bonus, but it's something I highly recommend you do because it's really important. That is to check the company's financial statements. So this is the 10K annual report or the 10Q quarterly report for US companies such as Adobe, or if you're looking into a company that's not a US company, you would want to check their investor relations page on their website, and it might not be called a 10K or a 10Q. So for example, Shopify. So let me show you how to get to both of these really quick. First, let's do Adobe. So for Adobe, we can go to the SEC's website since it's an American company, sec.gov. Link to this is in the description below. You want to click on company filings right here. And then after that, right here where it says company and person lookup, you can type in the ticker symbol. So ADBE. There you go, Adobe. Click that. And then you want to look for the 10K and 10Q quarterly reports. Just click that. And here we have the latest one, 10Q quarterly report that came out September 29th, 2021. You can click on that. And then from here, we'll be able to see the balance sheets and also the income statements. So here we go, balance sheet and also the income statement. So that's where you can go to find the financial statements for American companies or US companies. But like I said before, that's only for the US, but if it's a foreign company, non-US company, you would want to go to their investor relations page. So for example, Shopify. Let me show you how to do Shopify. You would want to go to Shopify's website right here. And then for most websites, you would want to look for something called investor relations or investor. Right here, they have investors. So yeah, let's click on that. And then after that, you want to click on financials, look for their financial statements. And then we can do like financial reports. So here they have earnings press release 2021. They have Q1 and Q2. Latest one is Q2 for 2021. So let's click that. And then you would just want to look at the document, search for the chart or the table showing the income statement and also the what do you call it? The balance sheets. Here we go. So the consolidated statements of operations and comprehensive loss. This is just a fancy word for statement of income or income statement. It's all the same thing. And then if you scroll down, you should be able to find the balance sheets. There we go. Condensed and consolidated balance sheets. So that's where you would go for non-US companies. All right, let's go back to the presentation. So that was step 6. Let's do a quick example with Adobe. So for example, for the balance sheets, you would want to look for first cash. Is it increasing or is it staying about the same? Ideally, you wouldn't want the cash to be decreasing. Some situations it could be okay, but uh, it's really on a case by case basis, not all cases, but in general, ideally cash increasing or staying about the same. So let's take a look at the balance sheet for Adobe. Here we go. Adobe balance sheets, cash and cash equivalents. So this is for 2021 versus 2020. You can see that 2021 cash it increased. So before it was at 4,400, now it's at 4,600. So you want it to be continuously increasing. Let's go back. Next, current assets. Are current assets greater than current liabilities? So let's go back. Current assets, total current assets right here, and then total current liabilities right here. Current assets, that's kind of like their cash and stuff that they can turn into cash quickly. Current liabilities, that's like bills that they have to pay really soon. So you want to make sure that they have enough cash or enough stuff that they can turn into cash to pay their bills that they need to pay soon. So that's why you want total current assets higher than the liabilities. And you can see here for 2020, this number is greater than this number, and for 2021 this number is greater than this number. So their current assets are greater than their current liabilities, so that's good. And then next, even better, it's not going to be like this for every company, but if you can find this for a company, that's a really good sign. Their cash is greater than their current liabilities. So for Adobe, this is not the case, but it's good enough. This is just the like ideal perfect case scenario. You would want their cash right here. You would want this to be greater than their total liabilities. So right now it's lower, but the thing is their current assets are greater than their current liabilities, so that's good enough. The reason why you would want cash and cash equivalents to be greater than current liabilities ideally is because if it's greater than they don't have to do as much liquidating, or they don't have to sell as much stuff to get the cash that they need to pay their bills. They already have it in cash right there. So yeah. Anyway, let's keep going. We did that. And last, total assets. You want to make sure that is more than the total liabilities. This is like their total bills that they have to pay. So total assets right here, and then total liabilities, that's all the way down at the bottom. You can see that the total assets for 2020 and 2021 are greater than the total liabilities for 2020 and 2021. And even better, if you can get total current assets to be more than total liabilities, that would be really good too. So total current assets right there, total liabilities. For Adobe, that's not the case, but if you do see a company with total current assets greater than total liabilities, that would be extremely good. All right, so that was it for the balance sheet. And then next, let's go on to the income statement. So for income statements, there's some other terms that companies use for this. It's not only called income statements. Sometimes it's called like consolidated statements of income or statements of operations. It's all the same thing. So for this, I like to look for increase in revenue or net sales. So sometimes you'll see revenue, sometimes you'll see net sales. It's very similar, pretty much the same thing. So here you can see Adobe. This is their consolidated statements of income. For total revenue right here, you can see that this is increasing over time. So 3 months ended. Let's look at the one for 2020. It's at around 3,200. For 1 year later, it's at 3,900. And for the 9 months ended in 2020, it's at 9,400-ish. Then 1 year later, it's at 11,600-ish. So total revenue is increasing over time. So that's what you want to look for. And also, you want to make sure that increasing net income is, or you want to make sure that the net income is also increasing. And do not get this confused with gross profit. That's what a lot of people tend to do. So here you can see all the way at the bottom, net income, that's what you want. The number all the way at the bottom, you want to make sure that that is going up as time goes on. So August 28th, 2020, It's at 955. 1 year later, for the 3 months ended, it is at 1,200. So their profit is increasing for the 3 months ended and also for the 9 months ended. Last year, 2020, it was at around 3,000 here. And this is all in millions, by the way, so you want to add 6 zeros to the end of these numbers. And for 2021, it is at 3,500, so it's increasing. So really quick, make sure you look for net income, not gross profit. You do not want to look at this number. This isn't their true profit. Look for net income, increasing net income. All right, I think that was it. Yeah, we did the increasing revenue and increasing net income. So yeah, that's it. Last slide. If you're interested in joining the Discord, Stocks Withdrawal, feel free to click the link in the description. In the Discord, I go over updates to my portfolios. If you want to check the portfolios out, check the Google Sheet stock link in the description as well. And yeah, my goal is to outperform the market. If you can't outperform the market, then there's no real point in choosing individual stocks, in my opinion. And yeah, also some other links right here. If you're interested in Barchart or the SEC website, you can find those links down in the description below. So yeah, anyway, that's it for today's video, and I'll see you in the next one.